All right, Michael, thank you very much. Michael Santoli. Our next guest says the market is setting itself up for, yes, a powerful rally. If this isn't it, we'll explore that with Michael Darda, chief economist and market strategist at MKM Partners. Michael, is this the rally you talk about, or is it not?
Well, it might be. Thanks for having me on. We've fallen very hard over a short period of time. So when that tends to happen, you get into overshooting, and then it really doesn't take much to start rallying the market. I wouldn't be honest with you if I was coming on here saying I could tell you exactly what rallied the market, because the inflation data this morning was not good. And the futures tanked on that. So, something else must have happened here to start turning things around. And you can still see the equity market very, very connected to what's happening with interest rates. And they shot up and then started to level off and pull back a bit. And, that's helped to stoke this rally off the lows.
So even though you can't, and I'm with you, I don't think, I've heard a lot of people talking on our air today trying to explain what's going on. I think it's impossible to do. I don't think it sort of defies explanation. I appreciate all the men and women who have gamely tried. But do you think that that if we're in a rallying phase, that it lasts, or do we have more downward direction to go here?
Yeah, that's really the critical question. I think we're setting up for a short-term rally. I'm not super confident that the rally is going to last. And the reason for that is it seems fairly probable at this point that we're probably heading for some kind of recession as we move into 2023. In the last 100 years, it would literally be unprecedented for the market to bottom and start recovering even before the recession started. Typically, markets are bottoming sort of halfway or two-thirds of the way through a recession. And this one has yet to begin. So assuming that, a soft landing is out of the question, then we might be looking at more of a temporary rally here. But we have come down very significantly. Valuations have compressed in a dramatic fashion over the last year. So as that unfolds, the bar really, goes lower and lower in terms of what could catalyze at least a short-term bounce.
Hey, Michael, this is Frank Collin here. So obviously a big surprise rally here. Nobody was really expecting what we saw today, but you believe we may have actually hit peak inflation. If we have hit peak inflation, where do you expect to see the numbers decline? It's hard to believe it could be in energy. We're seeing a production cut from OPEC that's expected to raise oil prices when it comes to wages. The labor market's still tight. And then we also saw that move in rent. So where are you expecting to see that softness in inflation that will give the market just that chance to take a breath and believe that we could see a pause or a pivot that could lead to a rally?
Yeah, it's been a dangerous exercise this year to be calling peak inflation, or peak bond yields for that matter. But I do think we're very close if we're not there now. And the reason I say that is typically these slower moving measures of inflation, you mentioned rental inflation, but essentially everything that makes up the core index, will follow business cycle momentum by about 5 quarters. And business cycle momentum was peaking exactly 5 quarters ago. We also have some measures of apartment tightness conditions in the rental market that were peaking exactly a year ago, and they tend to lead rental inflation by about a year. So the numbers should be hot right now. But over the next, say, 3 to 6 to 9 months, I think these numbers are going to cool. It doesn't mean that inflation falls like a stone, but as I mentioned before, it may not take much. We may just need to see evidence of a decisive peak and a move to the downside. And if that pulls bond yields down and that cools off these Fed tightening expectations, then that could at least put a temporary floor under equity markets.
So let me, I heard many people earlier today, it seems to me that this is the worst possible time to be selling heavily. It may not be the best possible time, best possible moment to buy, but I heard earlier Jim Lebenthal say that, if you miss out on days like this where so much of a market, of a bull market's gains occur, and I'm not saying this is a bull market, believe me, I'm not. But if you miss out on these days where it's up 600, 800 points, you are really missing out. Do you agree that this is a holder's atmosphere or a buyer's, a nibbler's atmosphere, certainly not a seller's?
Yeah, I think in the near term, for sure. If one had been short the market, I would be looking to cover here. If you've been long and you've gone down with the market, then I would say you can be a little bit patient in terms of unwinding those long positions if that's the intent. What we don't want is a situation that happened in June where some investors sort of realized right as we were down just over 20%, the market's way down, and they sold, and then we ripped 17% from there. And obviously that was given back as the interest rate structure started to come up again. But that's, really the key is trying not to get run over by these moves. And typically what happens with these markets, whether they're going up or down, is they encourage investors to do the wrong thing at the wrong time, overly optimistic at the highs and overly pessimistic at the lows.
It's tempting to do the wrong thing at the wrong time. I'm a personal example of that. Michael Darda, thank you very much. We appreciate your time today.
Thank you.